Welcome to the deep dive. If you've ever gone through the mortgage process, you know that stack of documents you get.
Oh, that feeling. It's less of a helpful guide.
Exactly. It's more like a legal challenge that's, just designed to overwhelm you.
And that feeling is precisely what regulators have spent really the last decade trying to fix. We're going to be diving into the pretty stringent rules that govern UK mortgage lending.
Right.
Specifically, we're looking at the disclosure and assessment steps under MCOB, which is the Mortgage Conduct of Business Regulations.
So our source material for this is basically the regulatory roadmap itself. We're mapping the borrower's journey from, I guess, the very first checks.
The affordability checks, yeah, all the way through to signing the final contract.
And our mission here is simple. We want to give you a shortcut through all these checkpoints.
We want to show you exactly where the law steps in to protect you, what info has to be revealed, and, why these steps are even there. It's about making sure you feel knowledgeable, not just buried in paper.
Exactly. So we're following the process step by step because the law is really strict that things have to happen in a certain order. And that very first big hurdle is proving you can actually pay.
So this first phase is all about responsible lending. It falls under a section called MCOB 11, and it's a core principle. The lender must be able to demonstrate that they've rigorously assessed your ability to repay.
And that's before they enter into the contract.
Before anything. And it's not just for brand new mortgages, which I think is a key point.
Right. That's what I found fascinating. These affordability checks get triggered, even if you're an existing customer just wanting to change your terms.
Precisely. So if you're extending your mortgage term into retirement, for example, or you're switching from a repayment to an interest-only mortgage.
Okay, that's a big one.
A huge one.
Yeah.
Even just adding or removing a borrower from the mortgage means they have to go back and do the full affordability review all over again.
Which makes sense. You're changing the risk profile. Now let's talk about the biggest change, the one that really came out of the 2008 crisis.
The ban on self-certification,
Yeah.
that shift was a huge deal. The rules now explicitly prohibit self-cert, where you could just, state your income without any proof.
So what do they mean now?
Lenders have to get reliable, verified evidence of your income. And this is the key, that evidence has to come from a source that is independent of you, the customer.
So, okay, let me ask a practical question. If I'm self-employed, how does that rule of independent verification make things harder for me compared to someone with a regular payslip?
It adds this whole extra layer of mandatory complexity. The lender can't just take your word for it, or even your own spreadsheet.
Right.
They'll want audited accounts from a certified accountant, or maybe HMRC documents, bank statements going back a long way. They need third-party data that proves your income is stable.
And that also means the lender has to have a written policy about what they look for.
Right.
It makes the process standardized.
It does. It puts the accountability back on them. And speaking of accountability, the record-keeping rule here is, I think, maybe the strongest piece of consumer protection in the whole book.
You're talking about how long they have to keep the records from the affordability check.
Yeah. They have to keep a record of all the information they used for that assessment for the entire duration of the mortgage itself.
So if it's a 30-year mortgage,
they keep that file for 30 years. And you compare that to, say, suitability advice records, which they only need to keep for 3 years. It tells you everything about where the regulators plenty most weight.
wait, so once the lender has proof you can pay, the law then says they have to show you exactly what you'd be paying for.
Exactly. Now we're in the disclosure stage. This is MCOB 5 and 5A. This is where transparency really kicks in.
And for most mortgages now, the key document is the ESIS.
The ESIS, yes. The European Standardized Information Sheet.
And we should probably pause on that because the ESIS exists because of the MCD.
Absolutely essential context. The MCD is the Mortgage Credit Directive. It was an EU-wide rule that the UK brought in back in 2016 to standardize everything and protect consumers. The ESIS is the result of that directive.
So if you got a mortgage before March 2016, you would have seen a document called a KFI, a Key Features Illustration.
Right. But post-2016, it's the ESIS.
So how is it different? What makes the ESIS so special?
Well, think of it like a standardized nutrition label for your loan. It has to follow a very specific format, so lenders can't, hide the bad stuff in the small print by moving sections around.
Okay, so what's on this label?
The really key stuff. The loan amount, the currency, the duration, interest rate, and the annual percentage rate of charge, the APRC.
Ah, APRC. So we're all used to APR, the annual percentage rate. Why the extra C?
The C stands for charge,
Yeah.
and it's a really important distinction. While a standard APR includes the interest and some fees, the APRC is designed to be more comprehensive.
So it includes everything?
It factors in all the cost, interest, application fees, valuation fees, even broker fees, all rolled into one single annual percentage. It's meant to be the ultimate tool for comparing the real total cost of credit.
That is incredibly helpful. But it's not just about the numbers, is it? The ESIS has to have these really explicit warnings about risk.
Correct. It has to be very upfront about the inherent risks. There are 3 mandatory warnings we should probably highlight.
Okay, let's start with the one for interest-only mortgages.
Right, so if the product is interest only, the ESIS has to have a clear warning that you, the customer, have to make separate arrangements to repay the capital at the end.
To stop people getting to the end of their term with no way to pay off the actual loan.
Exactly. Then there's the second one, the variable rate warning.
This one says your payments could go up or down?
Yes, and it has to give a concrete example, like a real hypothetical illustration of how much your monthly payment would increase if rates went up by a certain amount. It makes the risk tangible.
And the third warning is for foreign currency loans, and this one is super specific.
It is. If the loan is in, say, euros, but your income is in pounds, the ESIS has to warn you about currency fluctuations. And it has to specifically mention the potential impact of a 20% fall in the currency's value.
20%. That's a big number.
It's meant to be. It's a mandated stress test to grab your attention.
So once you have this ESIS packed with warnings, the advisor's job is to explain it. And the firm has to keep a record of it for 1 year from when you apply.
Okay, so moving from that initial illustration to the actual contract, we hit the offer stage. This is MCOB 6. And this is probably where the most powerful consumer protection in the whole process lives.
And again, we have to make that distinction between the modern MCD-regulated contracts and the older ones, right?
We do. For any MCD-regulated offer, so post-2016, the lender's final mortgage offer must be binding on the lender.
Okay, what does that actually mean? Binding on the lender.
It means once they make that offer, they are locked in. The rate, the terms, the fees, they can't just change their mind. It gives you, the borrower, enormous security.
But surely there must be some situations where they can back out of it.
Very few. There are really only 2 main reasons.
Huh.
First, if there's a material change to the facts, like, I don't know, the property valuation comes in way lower, or you lose your job.
So your income deteriorates.
Exactly.
Mm-hmm.
Or the second reason is if you, the borrower, knowingly provided false information. But as long as you're honest and your situation is stable, that lender is locked in.
And tied directly to this binding offer is the right to just pause, the reflection period.
This is such a great rule. The lender has to give you a reflection period of at least 7 days from when they issue that binding offer.
A mandated cooling off period?
It is. It's time to compare it against other offers, talk to a solicitor, or just step back from the emotion of it all.
7 days to breathe, but what if I'm in a rush? Can I waive that?
You can, yes. You have the right to waive some or all of that period, but it's a right you should think carefully about using.
And just to be clear, that 7-day period doesn't apply if you're just changing the terms on an existing mortgage.
That's a key nuance, yes. It doesn't apply when you're just varying an existing contract.
So let's quickly contrast that with the older non-MCD contracts from before 2016.
Right, those use the KFI illustration, and the big difference is the offer is not binding on the lender.
So they could just withdraw it?
They could, for a whole range of reasons, sometimes right up to the day of completion.
And the regulator made sure that risk was spelled out.
They did. If the offer isn't binding, the document has to have a specific warning that says, you are not bound by the terms of this offer document until you have signed the legal charge. There's no ambiguity.
And again, for record keeping, both types of offer documents only need to be kept for 1 year. It really shows how important that initial affordability proof is.
So we've made it to the final mile, MCOB 7. This covers the final disclosures, the last bits of information you have to get before you make your very first payment.
This is where it gets real then, moving from theoretical numbers to actual money leaving your account. What do they have to tell you here?
It has to be super precise. The exact amount and dates of your initial and ongoing payments, how they'll collect the money, and a final confirmation of the mortgage type repayment, interest only, or a mix.
No more estimates.
No more estimates. And the law also requires them to prepare you for what happens if things go wrong.
So payment difficulties.
Absolutely. The lender has to clearly explain what you should do if you get into arrears. And they have to point you directly to the tariff of charges that would apply.
They also have to tell you about any flexibility, right? Like overpayments.
Yes, whether you can make penalty-free overpayments or maybe underpayments.
Okay, now let's talk about the fees that really cause a lot of pain for people, the exit fees. MCOB 12 deals with early repayment charges, or ERCs.
This is where the law really stepped in to stop those nasty surprises when people try to remortgage. A lender has to disclose the ERC as a reasonable pre-estimate of their costs if you end the contract early.
So the charge can't just be a random penalty, it has to be linked to a real cost for the lender.
That's the principle. And crucially, that estimate can't be buried in a footnote as some complex formula.
So how must it be shown?
It has to be shown as a clear, transparent cash amount in the illustration documents.
A literal number in pounds and pence.
Exactly. And the disclosure has to state 3 key facts: when an ERC would be payable, the precise basis for how it's calculated, and the maximum possible ERC you could pay. The whole goal is complete transparency. #shagtag outro.
So let's pull all this together. What does this all mean for you? We've covered MCOB 11 affordability must be verified, no more self-cert. Then MCOB 5, which gives us the standardized ESIS with its really important warning.
Right, the 20% currency risk, the interest-only capital warning.
Then we looked at MCOB 6 and that huge difference between a modern binding offer, which gives you that 7-day reflection period, and the older non-binding offers.
And finally, MCOB 7 and 12, making sure the final payment details are crystal clear and that any early repayment charges are shown as transparent, calculable cash amounts.
I think the biggest relevance for you as a listener is knowing exactly when you are protected. The law builds in these compulsory pause points.
It does. Whether it's the time to consider the ESIS or that 7-day reflection period after the offer, you have a legal right to stop and compare.
The whole system is really designed to move away from, buyer beware and towards a system of informed consent, making sure all the risks are put right in front of you before you commit.
It's all about making sure you know what you're signing up for.
So here's a final provocative thought for you to take away, and it circles right back to the beginning. The lender has to keep your affordability assessment record for the entire term of the mortgage, maybe 30 years.
But the record of the offer document itself, the one with the actual interest rate and terms you agreed to, only needs to be kept for 1 year.
So what does that huge difference in how long they keep those records tell us about where the regulators place the highest legal priority? Is it protecting the lender from future claims of irresponsible lending? Or is it protecting your ability to challenge the terms of the original agreement years down the line? Something for you to mull over.